Collateral demand has never been higher. As a result, bank trading costs have absolutely skyrocketed. To address the problem, we're actually creating a new collateral marketplace that connects those with collateral to spare directly to banks in need at a significantly lower cost. What's the problem that we're trying to address? So significantly, for those of you that are old in the room like me and remember 2008, when we had the financial crisis, there was these things called derivative trades. Regulators responded by making banks post or hold more and more collateral to protect against loss. So in any marketplace, when you've got a scarcity, costs started to skyrocket. Collateral has really become the new capital. And when I talk about collateral, I'm speaking for the most part cash or currency that a bank keeps on reserve, sort of a rainy day. Think of us this way. On the one hand, banks are desperately in need of a lower cost, more efficient solution to source collateral, their collateral needs, to fund their trading costs. On the other hand, you've got potentially insurance companies, state agencies, and pension funds that have spare collateral that is available to rent, and they could do so at a much lower cost. It is a massive, massive problem. You know, we're talking about a private market, private derivative market, but by most estimates, you're talking about somewhere in the neighborhood of about a $3 trillion shortfall in trading collateral every single day. So think of our process this way. We've built a platform, which is a two-sided marketplace, where collateral givers and collateral takers can offer an expression of interest, and then we effect a match, you know, on the basis of certainly rates and terms, and they can negotiate through our platform, and then once terms and conditions are agreed, they can execute an order, send the agreement off to internal counsel, and satisfy the rental agreement. But we're much more than a collateral matchmaker. Specifically, we've got a forward-looking algorithm that actually calculates the projected costs, so what their shortfall is going to be, and then we do an offer valuation analysis that calculates what they would save by renting through our platform instead of going out to the dealer market. So this is massive. So there's no dealer in between, there's no dealer markup, and for the first time ever, banks have direct access to that market data so they can better inform their trading costs. So think of it this way. We're less Tinder and more Priceline. As I mentioned, our proprietary offer valuation analysis individually identifies what each of the savings opportunity and potentials might be if they were to rent through our platform. The important thing here is that we're not selling efficiency, although efficiency is part of that. That's a very tough thing to sell as somebody that used to do that. We're selling savings. We did a pilot trade, actually, which we're very proud of, with a French bank and a Dutch insurance carrier. From the bank's perspective, they were able to save $2.1 million in collateral costs with our very first trade. If they were to rent all of their shortfall through us, this particular bank would have saved $350 million annually. From an insurance or investor perspective, it's all about risk return, right? So we were able to put together a return for an insurance company with an A-rated bank for a one-year term at an above-market rate. So pretty safe investment, pretty great return. Our business model, we charge service fees, so we don't mark up the collateral. We're not a broker-dealer. We earn a spread based on what the bank is paying as part of our rental fee. And then we have a subscription model where they're able to access our real-time market data and business intelligence. So high gross margins and recurring revenues. As I mentioned, we take in terms of our revenue model, we take a 1% commission on each transaction, and we charge a subscription fee of $150,000 per year. That's less than 1% of the available market, as I spoke about, in terms of that shortfall. Our average fee, this is based on actually what we made on our very first trade, $45,000. We're projecting over a 3-year period in 2021 of $15 million in revenue. Our development timeline, so we spend a good amount of time in addition to working on our pitch, so thank you very much for that. But we spend a good amount of time working on our engine and our algorithm, making sure that that's where it needs to be. We're also working on further leveraging. I mentioned our first trade, so we want to do more of those with our bank. We've got a carrier that's lined up. And then we're also scaling. We've got expressions of interest from 2 banks and from a group of Japanese insurance companies as well. We're seeking 12-month financing to reach 3 bank subscribers and $370 million in collateral rental transactions in 2019. So we want to further scale, further build out our algorithm, and further reach out to the marketplace. When you roll that up, again, based on our average rental rate at 15 rentals, that's $1.1 million in revenue, in exchange for which we're seeking a $250,000 angel round. Myself, whom you've met, we have 2 other founders. Together, I know I look only 21, but we've got about 50 years of combined domain experience. Frank, in particular, has built trading platforms, repo platforms for some of the nation's largest banks, and Harendra as well has been in capital markets for about 10 or 15 years. We're also well served by some of the best advisors, including those here through Queen City Fintech. We're a Charlotte-based company, so some of them are really noted authorities in the collateral optimization and transformation space. Once again, our pre-seed valuation is $2.5 million. We just signed a partnership with a licensed execution facility, which will help us scale faster. So these are the places where banks do these kind of transactions. And again, we're seeking a $250K angel round. Thanks very much.